Welcome to the BDO Tax Support for Professionals seminar on transition to FRS 102. My name is Malcolm Pengelly. My contact details are on the slide in front of you. Today we're going to run through what is FRS 102, what are the changes from what we'll call old UK GAAP, and we'll look at the new standards, particularly FRS 102 and FRS 105. We'll look at the changes to accounting under new UK GAAP, the tax impact of those changes, and some of the key tax issues. So, new UK GAAP has been around for over a year now for SMEs, so they're starting to implement the changes. So let's have a look at what those accounting changes actually are. Former UK GAAP, this is the old UK GAAP, was withdrawn from 1st of January 2015. Okay. From that date, companies had a choice. They could account under EU IFRS, FRS 101, FRS 102, and the FRSI. Most SMEs would have continued to account under the FRSI 2015. But from 1st of January 2016, FRSI is completely withdrawn, and now the choice is between FRS 102 with some minor changes for disclosure for small entities, and FRS 105, which micro entities can use. So, what are the differences between FRS 102 and old UK GAAP? Well, some of the key changes are there's a different approach to financial instruments, including the recognition of derivatives at fair value. Historically, SMEs would not have recognized any fair value movement. There are changes to the recognition of intangibles on a business combination. There are changes to deferred tax, although we're not going to cover that in this session. And there is no multi-employer exemption in relation to group pension schemes, any liability having to be recognized on the company balance sheet. So, who's affected? The new reporting requirements affect small companies, and small companies are defined as those that meet two of the following conditions: turnover, 6.5 million, balance sheet total, 3.26 million, and an average number of employees, 50. The limits, as you can see from the table, are increased with effect from 1 January 2016. So, the changes are goodwill and intangible assets are always considered to have a finite useful life, and where it's not possible to make a reliable estimate, it will be presumed to not exceed 5 years. That's changed to 10 years from 1st of January 2016. This may mean that such assets are amortized more quickly than under old UK GAAP, which could potentially accelerate a tax deduction. At the end of each accounting period, it's also necessary to assess whether tangible and intangible fixed assets on the balance sheet need to be written down to a recoverable amount, having taken account of various factors, such as increases in market interest rates, obsolescence, and physical damage. These will obviously also have a tax effect. There are also changes to the definition of related party for the purposes of disclosing these transactions. Moving on to micro entities, the definition of micro entities, again, is to from turnover 632,000, balance sheet total 316,000, average number of employees, 10. The big difference for FRS 105 is that the accounting is much simpler, the disclosure is much less than under FRS 102, and we'll look at some of the differences in detail a little bit later on. So, looking at the measurement for things like fixed assets, it's not possible for fixed assets to be carried at valuation. They will therefore be carried at cost or amortized cost as appropriate. And the disclosure requirements are a lot less for FRS 105. This may save administration costs because the disclosure are less, but whether that information will be sufficient for banks and other users of the financial statements may well be something that the client needs to consider. So let's look at each of a number of headings where there are changes from old UK GAAP to new UK GAAP. First one is financial instruments. Financial instruments under FRS 102 are classified into two separate categories, either basic or non-basic. In general, basic instruments are measured at amortized cost, while non-basic instruments are measured at fair value, with differences taken through the profit and loss account. Okay. Examples of basic financial instruments include cash, trade creditors, trade debtors, loans, and investments in certain ordinary and preference shares. Non-basic financial instruments are more complex, loans and derivatives. That pretty much is anything that's not basic. Let's move on to derivatives. This is an area which we'll look at in detail when we come to look at the tax implications. Under old UK GAAP, most SME businesses tended not to recognise the value of derivatives on the balance sheet or in the financial statements until a cost was actually incurred. Under FRS 102, derivatives have to be fair valued. Okay? So derivatives include options, rights, warrants, futures contracts, forwards contracts, and interest rate hedging products. Moving on to long-term off-market payables and receivables. They're usually measured at the amount receivable or payable under old UK GAAP. Under new FRS 102, loans that are due in more than 1 year, which are not at a market rate of interest, need to be measured at fair value. An example of this that many SME businesses will come across are loans to or from director shareholders, which are made on an interest-free basis, and we'll look at the tax implications of this later. Business combinations and goodwill. It was rare for intangible assets to be recognised separately in the accounts from goodwill, which under old UK GAAP was generally taken as the difference between the price paid for the trade and assets and the specifically identifiable assets that were acquired, such as plant, stock, debtors, etc. Under FRS 102, there is more opportunity to split out from the intangibles heading goodwill, brands, trademarks, and such like, and to adopt differing amortization policies for each category of intangible. This may have the effect of accelerating amortisation and therefore a tax deduction. As we said earlier, goodwill has a rebuttable presumption of a 5/10-year maximum life. Lease incentives. The key point on lease incentives is that the recognition criteria are different under FRS 102, and it may mean that items that were categorised as operating leases or finance leases under former UK GAAP will be treated differently under FRS 102. Employee benefits. Unused holiday entitlement was generally not accounted for. It will need to be recognised under FRS 102. Investment properties. Under UK GAAP, an investment property was measured at fair value, usually market value, with changes via reserves no entry through the profit and loss account. Under FRS 102, again, the property is measured at fair value, if it can be determined, with changes being taken via the profit and loss account. This does not, however, change the tax treatment for investment properties, which are always capital gains tax assets, and any P&L movement needs to be added back in the tax computation and ignored as it is capital. FRS 105 applies to companies which qualify for the micro-entities regime, and we saw those limits earlier on. It replaces the FRSI. It's effective for accounting periods beginning on or after the 1st of January 2016. It's been specifically designed to reflect the simpler nature and smaller size of micro-entities, and a complete set of financial statements comprises a balance sheet with notes and a profit and loss account. Presentation of consolidated financial statements is not permitted, okay? And there are certain notes to be presented at the foot of the balance sheet as shown on the slide. There are some differences from FRS 102 that you need to be aware of. Assets and liabilities are measured at cost. There is no fair value adjustment permitted or required. Deferred tax recognition is not permitted. R&D costs are not capitalised. Borrowing costs are not capitalised. And there is no need to impute a market rate of interest to long-term off-market loan arrangements. So again, they will be carried at cost. Other than goodwill, intangible assets are not separately identified on business combinations, and equity-settled share-based payment transactions are not accounted for until the shares are issued. Or foreign currency transactions covered by a related or matching forward contract are measured at the exchange rate specified in the contract. So if we looked at the basic differences between FRS 102 and old UK GAAP. So what are the transitional considerations? From a disclosure point of view, there needs to be a reconciliation in the accounts between the old UK GAAP figures and the figures as stated under FRS 102. If there were accounting errors under the previous old UK GAAP framework, then these need to be dealt with as such and not wrapped up in the transitional adjustment. So there are some exemptions to retrospective application. So, accounting estimates. These are not changed on transition as a result of the benefit of hindsight. So if you measured something under old UK GAAP, you don't have to reevaluate the number under FRS 102. There are some optional exemptions. For example, business combinations. If exemption was not taken for a particular pre-transition date business combination, then all subsequent pre-transition date business combinations will also need to be restated. Use of fair value or revaluation as deemed cost. This applies to investment properties or other intangibles, and it may be attractive for companies that previously carried freehold property at cost, which now want to unlock some value into the balance sheet to carry these at valuation. Dormant companies, they do not need to make the adjustments and transition to FRS 102. They can continue to apply old UK GAAP. Lease incentives, so leases entered into prior to the transition, these can continue to be recognised on the same basis under old UK GAAP. There is also a general impracticability exemption, but this is only used or only allowed after every reasonable effort has been made to apply FRS 102. So let's look at the tax aspect and some of the key areas that we as a firm have encountered over the last year, 18 months. The key issues that we've seen are, which standard should one apply? Should one apply FRS 102 or FRS 105? Key area is what to do with transitional adjustments. And there are some specific areas that we have encountered: lease incentives, operating and finance leases, business combinations, computer software, loans and financial instruments. And there are also some tax elections which need to be made and to which time limits adhere. So let's look at the starting point. The starting point has always been the accounts as prepared under UK generally accepted accounting standards. That is your starting point for your tax computation. There will be adjustments that are required for tax, but it's the figure in the accounts, the profit in the accounts that one starts with. Importantly, where there is a move from one acceptable accounting basis, for example, old UK GAAP, to another, this will give rise to a difference between the opening figures for the year of change and the closing figures for the year before. And that change needs to be dealt with for tax. The general rule is that where profits were understated under the old basis, any taxable profit that's now brought into account on a change of basis is brought in on the first day of the accounting period in which the new basis is adopted. If, on the other hand, profits were overstated, then there is an allowable expense to be brought into account on the first day of the accounting period which the new basis is adopted. The end result is that no profits or losses, income or expenses, should fall out of account for tax purposes. So let's look at an example of a change. Let's look at lease incentives. Old UK GAAP provided that any lease incentive, such as a rent-free period or a reverse premium, was accounted for over the period to the first rent review. Under new UK GAAP, that incentive is accounted for over the whole period of the lease. So let's look at an example. Noddy leases a building to Big Ear. The 40-year lease term with a rent review to market rent after 5 years. The rent is £20,000 per annum, rent per annum, with a rent-free period for the first 4 years. So under old UK GAAP, we would have worked out the incentive, which is 4 years at £20,000, which is £80,000. We would then have spread that over 5 years, which is £16,000 per annum. Under new UK GAAP, however, we take the same incentive, 4 years at £20,000, is £80,000, but we divide it over the whole term of the lease. That is 40 years and a benefit of £2,000 per annum. Diagrammatically, this is what it looks like. Under old UK GAAP, the £16,000 rent-free period would have been dealt with over each of the years in which the incentive was paid, giving a net deduction for £4,000 per annum in the period to the rent review, and the full rent being payable £20,000 per annum thereafter. Under new UK GAAP, the rent was £20,000, the incentive is spread over 40 years, which is a £2,000 credit per annum, leaving rent of £18,000 in each of the accounting periods. As tax follows accounts, you can see from this table that under FRS102, there is an accelerated tax benefit. In year one, for example, you're paying no rent. Under old UK GAAP, you would have had a tax deduction of £4,000, but under FRS102, that tax deduction increases to £18,000. There is no overall increase in tax relief over the period of the lease, but the relief is accelerated to earlier accounting periods. Let's have a look at finance leases. Under old UK GAAP, leases were categorised as either finance leases if the net present value of the minimum payments was at least 90% of fair value of the asset, or, in other cases, operating leases. The definition of a finance lease under FRS 102 is such that if the term covers the major part of the asset's expected life, i.e. about 75% or more, it is a finance lease. As a result, some leases that were formerly treated as operating leases will now, under FRS 102, be treated as finance leases. And as the tax treatment follows the accounting, tax relief will be given on a different basis, i.e. instead of being given for the rental payment on a previous operating lease, it will now be based on the depreciation and interest charge in the accounts. Here is an example. Let's assume, for the purposes of this example, we have a 7-year lease with a rent of £120,000 per annum. The fair value of the asset is £720,000, and the net present value of the lease rentals is £660,000. If we look at the table, you'll see in the left-hand column that in the years 2013-2014, tax deduction is taken for the rent paid, £120,000 in each year. However, when we adopt FRS 102, we need to restate this as a finance lease asset because under the old UK GAAP, the net present value of the lease rentals was 86% of the fair value. It was treated as an operating lease. However, under new UK GAAP, the term of the lease represents 78% of the expected asset life and is therefore treated as a finance lease. You'll see from the table that the tax deduction under FRS 102 now starts to look at depreciation and interest, as you can see from the right-hand column. Let's look at those figures in a little bit more detail. If we look at the historic position for this particular asset, it starts in 2013 with an asset of £660,000 and a liability of £660,000. Having restated it in such fashion, we would then depreciate it, which was the £94,285. Let us say that the finance charge, which I've called interest in this example, is £40,000. That makes the liability larger, and you'll recall that we were paying a rental payment of £120,000. So if we look at the end of 2013, the adjustment to be made is £14,285. If we revert back to the previous slide, you'll see that a tax deduction is taken for that there on the right-hand column. We do the same for the closing balance at 2014, by which time the net present value of the asset has taken another year's worth of depreciation and taken it down to £471,430. On the financing side, we have another year's worth of finance charge, stroke interest, and another year of rental payments. So the liability is now down to £495,000. That's an adjustment of £9,285. That £9,285 is also tax deductible, as you can see in the right-hand column. Moving on to 2015, which is the year in which we're now fully accounting for FRS 102, one takes an adjustment for depreciation, £94,285, and then one takes the interest charge of £30,000. We no longer need to account for the rental. So those are the final figures in the table on the right-hand side, a tax deduction for depreciation and interest, and that is the way it will continue going forward. Business combinations. Historically, under old UK GAAP, one would account for the various components of a business combination, an acquisition of trade and assets, for example. So one would have acquired some tangible assets, some stock, and some creditors, and the difference between that and the amount paid would have been goodwill. Under FRS 102, it is possible to allocate more intangibles. So yes, we'll probably still have some goodwill, but there might be customer lists or brands or something similar. So, as I mentioned earlier, restatement is optional, but why might you want to restate? So that you can recognize intangibles with a shorter useful economic life than goodwill, such as customer lists. Customers come and go. If you're going to do that, and you're recognizing something with a shorter useful life, this will accelerate tax relief. Bear in mind, though, this is a timing benefit only. You're not going to get a tax deduction for more amortization relief overall. So let's look at an example. A business was purchased in 2014. It cost £5 million. That £5 million was split into £3 million of net assets that are identifiable and a balance of £2 million for goodwill. The goodwill is amortised over 10 years. Included in that £2 million is a customer list valued at £500,000, which has a useful economic life of only 5 years. What would the effect be of restating the figures under FRS 102? Well, under old UK GAAP, we would have started with a £2 million figure for goodwill and amortised it over 10 years, that is £200,000, leaving a balance at the end of the year of £1.8 million. Under new UK GAAP, FRS 102, we would still have £2 million worth of goodwill, but we would amortise the goodwill of £1.5 million over 10 years, that's £150,000, and the customer list of 500,000 over 5 years, that's £100,000, leaving a balance sheet value of 1.75. That is a difference of £50,000, which is brought into account at the 1st of January 2015. Same example, slightly different way of looking at the same calculation. I'll leave you to peruse that at your leisure. Computer software. Computer software has, under old UK GAAP, been treated as a tangible fixed asset, and capital allowances have been available. Under FRS 102, it may be possible to account for this as an intangible rather than a tangible asset. What effect does this have? Under the current tax regime, capital allowances is probably more favourable if you can claim the 100% annual investment allowance. If you bought software costing £20,000, you'd get 100% annual investment allowance. In the absence of the annual investment allowance, you would get capital allowances on the asset instead. If you had taken the intangible approach, then your intangible would have been depreciated for 5 years, let's say £4,000 intangible amortisation. That would have been your tax deduction. So the table shows your tax deduction on the basis of 3 options available to you: annual investment allowance, full upfront tax deduction, capital allowances, and reducing annual tax deduction until the very end when you get a large tax benefit, and intangibles spread equally over the 5 years. Financial instruments. The original principal of the loan, that's the capital outstanding, is carried at amortised cost unless fair value accounting applies, i.e. it's not a basic instrument. In most cases, for a basic instrument, it's going to be carried at historic cost value. If it's not basic, then the instrument needs to be fair valued. In either case, interest charged on that instrument is charged to profit and loss account, and a tax deduction is taken, therefore. But as mentioned earlier, when we're looking at basic or non-basic loans, most types of debt instruments will qualify as basic. Such things as receivables and payables to suppliers, customers. But conditions for qualifying as basic are outlined in para 11.9 of FRS 102. For example, the return on the loan must be one of the following: a fixed amount, a fixed rate of return over the life of the instrument, a variable rate of return that throughout the life of the instrument is equal to a single quoted or observable interest rate, such as LIBOR, or a combination of such fixed and variable rates. So these are normal commercial loans. Non-basic payables and receivables include more complicated instruments such as interest rate swaps, and these are accounted for at fair value. And this is where the challenge comes for tax practitioners. Let's look at distressed debt. Occasionally, a bank will enter into an arrangement with a debtor in recognition of the fact that this debt instrument may not be repaid in full. At that stage, one has to de-recognise the debt, and the new instrument, i.e. to reflect the new terms of the deal with the bank, needs to be recognised at fair value. This will give rise to a taxable gain or loss if the arrangement with the bank differs from the original terms. Let's look at an example. X Limited has outstanding loan principal of £1 million owed to a bank at the 31st of December 2014. On the 1st of July 2015, the bank agrees to write off £250,000 if the remaining balance of £750,000 is paid off over 3 annual instalments. This will cause the current value of the liability under FRS102 to fall to £750,000 on the 1st of July 2015. So, assuming the annual instalments are made, X will then be released from the remaining principal at the end of the term. Let's see how old UK GAAP would have dealt with this. So, old UK GAAP will have looked at this on a year-by-year basis. At the point that the agreement was reached with the bank, no recognition of the £250,000 potential write-off / reduction would be taken into account, and the customer during the year ended 31st of December 2015 would have made his £250,000 repayment as normal, and the debt would have been carried at £750,000 at the end of the year, i.e. the full amount that is still outstanding to the bank. This would then carry on through 2016, 2017, when the bank will say, you've met the conditions, we release you from the final balance. And it is only at that stage, under old UK GAAP, that the £250,000 credit would be recognised in the accounts, and accordingly, it is at that stage that the £250,000 credit would be taxed. Let's look at it under FRS 102. The rules under FRS 102 is that we start the year with a £1 million balance due to the bank, but having struck the deal on the 1st of July 2015, it is at that point that the taxable credit is recognised, i.e. in the year ended 31/12/2015. This has therefore had the effect of accelerating a taxable credit by 2 years. Another area which causes difficulty are directors' loans. Here's an example that we've had recently. Under FRS 102 and 105, one needs to consider whether the loan is repayable on demand or whether it is repayable more than 12 months after the date on which it was issued. Of course, under old UK GAAP, the loan would have been carried at full value throughout. So, if the loan is repayable on demand, nothing much has changed from old UK GAAP. You're recording the loan at its full value on the slide called the initial value. If the loan is interest-free, there are no tax implications of that. If interest is charged, then the interest is an allowable expense. If it's paid by a company to a human being, tax needs to be accounted for on Form CT61. Under FRS102, if the loan is for more than 12 months and is at a zero interest rate, for example, one would need to record it at fair value. In other words, a 10-year loan of £1 million at 0% is not today worth £1 million and needs to be discounted to a lower number. The question is, what does one do with the difference between £1 million and the lower number? Before we go on to that, FRS105 users can continue to record the loan at its historic figure. So, we've determined that we need to discount the director's loan to present value using a market rate of interest, and on transition, that discount is taxed over 10 years. So if a £1 million loan was to be carried at £800,000 on transition, the £200,000 credit will be taxed in equal instalments over 10 years. Post-transition periods, generally speaking, the credit is not taxable, and the corresponding debit, when it reverses back, is not tax deductible. Here is an example. Let us assume that a director has advanced £720,000 to a company. Under FRS 102, this loan, because it's interest-free, is only recognised at £660,000. So, at 31/12/2014, we've charged some interest on that loan of £660,000 to take it up to £672,000, but there is an adjustment required to get from £720,000 to £672,000. The £48,000 is the transitional adjustment to the historic figures. That is taxed over 10 years. In 2014, the £10,000 interest is tax relieved. Connected party loans between companies has no impact. They have a special set of rules under the loan relationship provisions, and any adjustments as a result of FRS 102 are not taxed. Financial instruments. Under old UK GAAP, any adjustments were generally off balance sheet, i.e. they were not recognised through the accounts. Income and expenses on interest rate swaps were taken to P&L as and when they were recognised. Under new UK GAAP, the financial instrument needs to be recognised at fair value on the balance sheet. This will give rise to an adjustment when the fair value amount of the financial instrument is taken to the balance sheet. This will give rise to either a debit or credit through profit and loss account. Again, best illustrated by an example. Let us assume that we have a 3-year swap taken out on the 1st of July 2015. By the 31st of December 2015, this swap is in the money to the extent of £300,000. If nothing is done, that credit is taken to the profit and loss account and taxed there. At the 31st of December 2015, if it's not taken to the profit and loss account, but taken to the OCI, the Statement of Comprehensive Income, then only £100,000 actually hits P&L. In that case, it's only the recycled amount which is taxed, not the whole £300,000. So accounting is important here. Depends whether you take your figures through the profit and loss account or recycle them through the statement of comprehensive income. It is possible, in certain circumstances, to make what is known as a disregard election. There are time limits for this, as set out on the slide. And if you do that, then generally speaking, the old UK GAAP position is restored. So the issue with swaps is if no action is taken, the movements tend to be very volatile. For example, here we have a £300,000 credit in 2015 being taxed all at once. Next year there might be a movement the other way, and that will be taxed correspondingly or tax release correspondingly. So disregard elections and recycling through the statement of comprehensive income may well spread out the adjustments and make it less volatile. Example number 2, same facts as example number 1, but we've changed the date back to 1st of January 2015. In that case, we have a £300,000 credit, but because it is a transitional adjustment, that can be spread over a 10-year period, and it is taxed in equal instalments of £300,000. So, what are the key tax issues to watch out for on the change to UK GAAP? Well, as we have demonstrated, the tax deductions and taxable receipts as a result of the change of accounting policy to FRS102 will change the tax profit and therefore the tax payable, i.e. the tax cash. So it's important for finance directors and accountants to realise how much difference this is going to make to the tax that is paid to the taxman at the end of the year. One needs to consider, for existing lease arrangements, whether one needs to restate the basis on which incentives have been accounted for, or whether one can continue looking at the old basis where the incentive is spread over the period to the first rent review. One needs to look at trade acquisitions to see if there is an opportunity to identify intangibles that are depreciated at a more advantageous rate to accelerate a tax deduction. Look at your plans for expenditure on computer systems. Have a look to see whether capital allowances or an intangible deduction is more beneficial. Complex financial instruments, look at these in detail. Have a look and see what effect this is likely to have on your accounting, whether you need to make any disregard elections or exactly how you're going to treat it. This will have a direct tax impact. Loans to and from shareholders, if they're not repayable on demand, then some sort of adjustment is likely to be necessary unless they're bearing a market rate of interest. This again will give rise to debits and credits that are likely to be taxable. Again, finally, if companies are being relieved of their debt obligations by a bank, this is likely to accelerate a taxable credit. So be aware of these. These all lead to increases in tax payable. If you have any questions on this presentation, please call us on the BDO Tax Support for Professionals helpline. Numbers are on your screen now. We also have a LinkedIn page. If you'd like to join the group, again, call the number 0345. Sorry, I'll say that again, 0345 356 0006. Thank you for your attention.